Hi investors, thanks for joining me. It is time for another thrilling session of Q&A where my Patreon members ask the questions and I, based upon my 28 years of investing experience, time with Mark Minervini's MPA, IBD, etc., answer their questions, or at least attempt to. 3 things before we begin. Number 1, this is not financial advice, it is just my opinion. Number 2, if you want to pose a question, you can consider joining my Patreon 7-day free trial, link in the description below. And 3, I don't remember what 3 was, so let's just go with 2. So first I have a plethora of questions from a Patreon member, 𝗕𝗨𝗬, gosh, I'm not sure. Let's see, his first one is the easiest one, so let me handle that one first. Could you talk about what one should study or look at in stocks to get good at this, like studying successful breakouts, for example, and getting better at recognizing price patterns? So 3 recommendations. The first one is there's no substitute for screen time. The more stocks, the more charts you look at per day, the better. The more years you do it, the better you will get at getting a feel for predicting price based upon charts and the personality of charts. Every stock has a different personality, so to speak. It's just like shooting free throws, right? You learn the basics and then it's just all about that repetition. 2 other things though. One, you've probably heard of this book, William O'Neill's How to Make Money in Stocks, one of the Bibles of investing, so to speak, and a large part of it is just chart patterns of famous winners in history going back from the early 1900s to the 90s and more modern ones. And then if you really want to get deep in the weeds, the Encyclopedia of Chart Patterns, Thomas Bolkowski. This book is really expensive. I think it's like $100. You might be able to find it used somewhere. I've got links to both of those books in the description. Now, your other questions were about volume. Let's look at your other question. All right, let's see. How do you identify volume on breakout day? I've had some challenges calculating how strong the volume is. I understand one can't always expect a 1-2 punch, as Mark Minervini mentions in his strategy. I actually made a video about the Minervini 1-2 punch. I might be on there somewhere on the YouTubes. How do you determine if a stock has strong volume on breakout day? Many of the breakouts occur at market opening. That's very true. It's always interesting to know if the volume is stronger than usual in opening or not. All right. So the simple answer and complicated answer. If you really want to know what volume is, what I personally use is stockcharts.com. Sorry, I use that for charting and annotations. But for tracking volume, I use formerly MarketSmith, MarketSurge, and at any given moment, it will tell you the volume so far, but also the percent above average. So here's 𝗂𝗪𝗂, who made a nice move today, and it was 72% up on volume. But even in the first 5 or 10 minutes of the market open, it will show you what percent above or below average it is. And then down here on the volume bars, this red line is the average. So you can also see visually at the end of the day how big of a move it was compared to the average move. And today was a nice blue bar on high volume. But then I told you to watch a recent webinar by Mike Webster called Volume is Dirty, how he really talks about how volume is not the foolproof elephants in the pool indicator that it used to be. And now, in my opinion, it's the icing on the cake. Yes, we love to see big volume, but it's not necessary. And I'll give you 2 examples. And I'll put a link to that video as well in the description. Boy, I'm making this kind of complicated for myself. But basically 2 things. One, the institutions now can hide their purchases in dark pools, so they don't always register the big elephantine footprint. And then two, so many stocks are being bought by ETFs that sometimes a giant volume bar is simply an ETF filling out its allocation. And we want to see the institutional buying because it occurs over multiple days or weeks or months. Whereas the ETFs, it's not like that. An ETF volume bar is not as such a significant indicator that the stock's going to keep going up. All right, so let me show you two examples. Here is that's Costco. Here is AFRM, Affirm Holdings. And what I told you in my response was what absolutely is still valid or helpful is looking for a drying up. So here you've got, let me turn this off. Here you've got this little cup with handle. You've got a double bottom within the cup. This is called a fractal. And this is a little cheat area, but it's pretty loosey-goosey. But here you get a decent little high handle, cup with high handle. And look at the volume. See how the volume dries up. And this down day was the lowest volume out of any of those days, and it was an accumulation day. Look at that. It was a dragonfly doji. So this, more than anything, when you see a tightening, a quieting of price, and a quieting of volume, that tells you that the price is going to move soon. And then it's just a matter of which way it's going to go. Here's another example. Now, sometimes you do get that buying. Here you see a 1-2 punch, two really strong volume days in a row. That's a great sign. One of your questions you ask later is, how do you know when breakouts are working? When you get this 3, 4, 5, 6 days of buying in a row. Look at this. This went up 44% and 1, 2, 3, 4, 5, 6 days in a row before it bled off a little bit. That's how you know breakouts are working. But look now at the time, late November, early December 20. Look at what was going on in the S&P 500. Late November, early December, we had this huge vertical bull run. And so Affirm wasn't the only stock that the breakout worked on. Most stocks that broke out had these explosive breakout moves. So that was what I told you in my response earlier, is that better than looking for big volume, because you don't always get that. What you want to try to do is have your finger on the market and see whether breakouts are working or not. Usually it's one of either three things. Breakouts are working and extending multiple days. Breakouts are squatting, pulling back into the pattern, and then breaking out and working later on in a handful of days. Or breakouts are squatting and pulling back into the pattern and then kind of meandering or drifting down. We saw that a lot in 2022. So figure out, that's the best way to know if a breakout is going to work or not. And then, of course, you don't, and that's why you set a stop. You buy it here, you set your stop. Ooh, that's 13%. You'd have to set it right here at about 25, and then it either works or it doesn't. And even in the best of times, probably only 60% of the time, it's going to work. And so how do you know whether what's happening to stocks after breakout? There really aren't any shortcuts. The more work you do, the more successful you're going to be. For example, if you see a shipping stock break out, then what you want to do is you want to look at all of the shippers. So what I would do, I go to stockcharts.com and I would find my list of shippers here. Right, where are they? pull up my list of shippers. I would go chart list view, and I'd scroll through and see what breakouts are doing. This breakout worked pretty well, etc., etc. This breakout worked pretty well, etc. Alternatively, there are plenty of traders who look at the entire S&P 500 every day or every other day. Here's the S&P 500. Pull it up. Scroll through 500 charts. Once you get good at it, it's only going to take you, 10 minutes or something. I can go about that speed. You can get a real feel for the market. This is going to tell you a lot more about what the market is doing than any so-called expert on the internet. The sad, I don't know if it's sad, but the reality is, if you want super performance, you got to do the work. You got to put in the chart time. And if you're not willing to put in that time, then you're not going to have super performance, and you might be better off just averaging in to a few mutual funds, the SPY, and so forth. Now, one other thing I'll say about that is you try a couple. Let's say you tried this one, and okay, here's a better example. AMCR. Let's say you tried this little breakout and it failed, and then you try another one and it failed. Then you pause a minute and take a couple pitches, meaning you watch a couple breakouts and see what they do. So you put real money down on a couple of them. If they don't work, then take a pitch or two and look and see what happens. And then if you see them working, then you can commence breakout buying. Breakout buying works fantastic, but only, I don't know, maybe 3 months out of the year, out of an average year. Much of the time, things are in trend channels or they're choppy, and you're better off buying off of trend lines, pullback buys, etc. Yeah, so I wanted to show you one other thing, and then we got to get on to a different question. Big volume is nice, but it's not essential. Here's Costco, C-O-S-T. Here's a reasonable, decent, I guess we could call this a saucer base. And here you got a little pullback, and here is your breakout, okay? Look at this volume. It is barely above average, if at all, and then it ramps up for a few days, has a little pullback, gets in a little accumulation towards the end of the day, then it ramps up again, and then it ramps up again. So the institutions were buying here very quietly for like a month. And what happened then? You had a 35% move in just a couple months. So certainly we love to see that big explosive buying by volume on the breakout, but it's really not necessary. And it's more and more we see stocks making big moves without initial big volume. Incidentally, when you get big volume after a breakout, it can be climactic, like here and here. Okay, next, let's see. Lee Ann wants to take a look at INTU. Let's pull it up on Market Surge first. Provides INTU computer software. Software traditionally is a really good industry to trade in. It's in the upper third of industries right now in performance. Provides business, financial, and tax software services. Earnings are coming up in 7 days. I probably, on that alone, would only put on a very small position or wait until after earnings. But let's pretend. So keep that in mind. Let's disregard that. Last quarter's earnings were pretty tepid. 20% earnings growth, 11% sales growth. Not super impressive. Although it's a very profitable company and it's a mature company, so they're just not going to grow as fast as, a small cap growth stock. Little dividend of 0.5. Looking at the weekly, you got a nice cup with handle. Handle is turning into a cup of its own here. Looking at the monthly, pretty nice monthly chart. I'm going to just assume it's outperforming the S&P 500. I don't want to take the time to look that up right now. Looking great on the monthly chart. I prefer to look at the actual charts on stockcharts.com. And if you ever want to subscribe to it is only about $20 a month. And if you do subscribe, please put in my email in the referral box, joe'sinvestmentexpress@gmail.com, no apostrophe. And while we are at a pause here, if you could like the video, that would help get it out to more people. Okay, so I really like this chart. Let's put this on my focus list. Actually, you got a strong prior uptrend. You've got a mellow pullback while the market was pulling back, only a pullback of about 11%. Let's see what our relative strength is at, actually. 81. Minervini's general cutoff is at 88. And that's a good rule for beginners and intermediates. I think sometimes it will keep you out of stocks until they get a little bit extended. In this case, like I said, I really like it. You've got, in fact, let's just draw this in. You've got a pretty nice left side here. It just broke the left side, gapped out. This was just on the big follow through day there. I don't think there was any news there. And then you got a quiet day here. I think that absolutely, let's put this on our focus list. I think that absolutely you could buy this. Yeah, look at that. That bar is only about 2%. So what I would probably do personally is buy this if it prints an inside day here. And then if it undercuts here, I'd sell it for like a 2% loss and just wait and reevaluate. I think there's a good chance that it does not close this gap and builds out the right side. And then you can sell a quarter, a third, or a half around 670 and wait for it to handle out. Yeah, nice chart. Here's the double bottom, by the way. Classic double bottom. Okay, easy money, e-money. FICO, yeah, I've been in and out of the stock many times. I have a position in it right now. E-money bought a half position in FICO on May 7th. Let's look at that buy point. Up quite a bit. I've been struggling with when to commit to full positions. How would you have played this one? So I did play this one. Let's see how I did it. So this is pretty awesome. You and I actually bought it on the same day, May 7th. I actually bought it way back here on November 9th. Sold a piece up here, and then I added that piece back on here. Came in with the general market, did not tag up with the 200-day, which shows that the institutions were anxious to get back in. Carved out this double bottom here, and then I wanted to see it close but above the 50-day, and then when it came back in and printed this little demand hammer, Dragonfly Doji, technically, that's where I bumped it to a full position again, and that's where you bought it as well. So I think that's a good buy. Definitely a good buy. So now you want to increase your position, and so do I. But guess what? There, it is not given us. We need a platform to trade off of so we can control our risk. If we buy it right here, how do we know when the trade has failed? How do we know? You'd have to go way down here to know that the trade has failed. So until it gives us another buy point, in my opinion, we cannot add to our positions. Whenever you want to add to a stock, ask yourself, if I didn't own this stock, would I be comfortable buying it here today? If the answer is yes, then you add to it. If the answer is no, then you just got to be satisfied with the size of the position that you have. When you have a stock, unfortunately, large caps are more prone to kind of V bottoms. Now, this isn't exactly a V bottom. If you ever look at the Tesla chart, it's got V bottoms all over the place. But by that, I mean they often blast right up the right side and out without giving much of a handle, which is why you need to try to cheat into them within the cup when you can. But here's the ideal. Let me show you an ideal situation for adding to a position. Here's Coca-Cola. All right, here's a nice cup. So what we would do is we would get in on the low cheat. Here's the low cheat. All right, so we would do a half position here, and then when it runs up, makes a nice handle and breaks out of that handle, then we put on a full position. And if you want to get really micromanagerial, you could put on half your position here, sell half of that half when it gets up close to the all-time high, and then add that back on when it breaks out again. Because sometimes the stock will run up to the all-time high and then come back down or print a double bottom or take weeks to break out again. So we need to wait for FICO to give us some sort of tight area to trade off of. See this nice tight trading area? If this would have broken to the upside, although it's too high from the 50-day, so that's not really a good example. Let's move on to the next question. Yeah, okay, the other question was from David Taylor. I noticed when interpreting charts that patterns can differ when using log transformed versus standard axis. From your own experience and from what you've learned from Minervini and others, which do you prefer? For example, looking at a 1-year daily GCT chart, pattern is much tighter using the log chart. Okay, so I heard Minervini answer this question verbatim in a Q&A session of his. He said that he uses logarithmic, and pretty much everybody uses logarithmic, and therefore we want to be staring at the same charts that everyone else is staring at. So we want to use logarithmic rather than arithmetic, I suppose. We want to be looking at the same charts as everybody else. Incidentally, that's why you want to have the simple 50-day moving average and the simple 200-day moving average on your charts, because most traders have them on their charts and often make buying and selling decisions. See this action coming off the 200-day, for example. The 10 and 21 and 20-day, that's a little bit open to debate as to whether to have that or not. That is kind of a rabbit hole. But what the heck is logarithmic versus linear or arithmetic? A really good source for any sort of investing question is Investopedia. Let's take a look. So a logarithmic price scale is plotted so that the prices in the scale are not positioned equidistantly, equally from one another. Instead, the measure is plotted in such a way the two equal percent changes are plotted as the same vertical distance on the scale. Most technical analysts and traders use logarithmic. That's what I just said. Commonly recurring percent changes are represented by an equal spacing between the numbers in the scale. For example, the distance between 10 and 20 is equal to the distance between 20 and 40 because both scenarios represent a 100% increase in price. Logarithmic price scales are better than linear price scales, showing less severe price increases or decreases. They can help you visualize how far the price must move to reach a buy or sell target. If prices are close together, they can be congested. So just keep it simple. Leave your charts on logarithmic like you see here. Here's GCT in logarithmic form. In linear or arithmetic, you can see quite a difference. Incidentally, I like this chart a lot. GCT, you got a nice prior uptrend. You've got some VCP action. Let me draw that in here. Not perfect VCP action yet. Volatility contraction is what that is. Mark Minervini, volatility contraction. You got a large, you got a medium. Looks like we got another medium. We want to get a small and a smaller. Certainly we're getting kind of a kind of an ascending triangle. Not a perfect one, but I like the tightening. Let's see the volume quiet down as well. This is, I think this one is going to break out at some point if the market stays strong and the fundamentals are really good. All right, you guys, that's all the time I have right now. I'll be sure to like the video. You can subscribe if you want to see more of my free YouTube videos. If you want to participate on my Patreon, there's a 7-day free trial. And lastly, while I'm promoting stuff, you might consider taking a look at Seeking Alpha Premium and 𝗕𝐵_Pix. It's an amazing resource for fundamental information and analyst articles. Not to mention, you can keep a portfolio or 10 portfolios, whatever you want to, on here. Links for those are in the description below. I'll see you in the next one.